Continuing on with accounting for a defined benefit pension plan, we have our next example. Thornton Electronics has the following balances. The projected benefit obligation is $1,500,000, which, if you recall, is not directly reported on the balance sheet, but is detailed in the notes to the financial statements. The pension fund has a balance of $1,385,000, again, not reported on the balance sheet, but in the notes. The difference between these is the pension-related liability of $115,000, which is reported on the balance sheet. We also have a new element to throw into the mix, which is called prior service cost. Prior service cost is reported as part of accumulated other comprehensive income, which, if you'll recall from earlier chapters, is reported on the balance sheet. To continue the example, we'll first cover what prior service cost is. Prior service cost, often abbreviated PSC, is the cost of additional benefits that have been granted to employees for services the employees performed in prior years. This cost is not recognized immediately as an expense. Instead, it's reported in accumulated other comprehensive income and amortized over future periods. Thornton adopts a new plan at the end of 2012. An actuary determines the amount of prior service cost is $75,000. In the textbook, the initial journal entry is shown with a debit to other comprehensive income and a credit to projected benefit obligation. Unfortunately, this is a bit misleading because PBO is not an account to be reported on the financial statement. What they don't show you is the closing and summary pension entries from the previous year, leading you to believe this is all there is to it. It's presented as a journal entry in the text to show you the effect prior service cost has on accumulated other comprehensive income and the balance in the PBO, which will be shown as beginning balances in the worksheet. The prior service cost has the effect of increasing the PBO and decreasing other comprehensive income, thus decreasing accumulated other comprehensive income. As you read through this example in the textbook, think of the journal entries presented not as journal entries, but worksheet entries, which we'll review next. I find this presentation to be confusing, so I'm going to walk you through the worksheet and then focus on the actual summary journal entries, which from a practical perspective is what you need to know. Presented here is the start of the pension worksheet, which is a common tool used by accountants to track complex pension computations. Notice two main columns. We have accounts on the left, which are reported in financial statements. These include pension expense, cash, pension-related asset or liability, and accumulated other comprehensive income. These are the accounts to use in summary journal entries. On the right, we have our PBO and pension fund, just as we did before, which we keep track of because the balances in these determine how much we report on the balance sheet as pension-related liability. Finally, we have another accumulated other comprehensive income column, abbreviated AOCI, for keeping track of the prior service cost that we're going to amortize. The balances entered here are the ones displayed at the beginning of the video. Let's work through the example. Thornton, in the first year, has service cost of $75,000. Remember, this amount is supplied by an actuary. Thornton made contributions to the plan of $115,000 and $125,000 was paid out of the plan to employees. The fair value of the pension fund at the end of the year is $1,513,500. This will be important to determine the actual return on plan assets. We have an obligation discount rate of 11%, which is used to calculate interest cost, and an expected rate of return of 10%, which is used to calculate expected return on assets. Let's go through the worksheet one item at a time. First, we have service cost, which is given as $75,000. Remember, service cost is a component of pension expense. It increases the PBO. It increases pension expense, which is reflected here with a positive amount recorded in the pension expense column. It increases the PBO, which is reflected here with a negative amount, which indicates a credit in the PBO column. Next, we have interest cost, which is the beginning balance of the PBO, which is $1,500,000, times the obligation discount rate of 11%. The interest cost is recorded in the pension expense column as a positive number because it increases pension expense, and as a negative number in the PBO column because it increases projected benefit obligation. Now we have return on assets. When completing a worksheet, we always use the actual return on assets. In the previous example, it was labeled expected return, but only because the amount was the same. On the worksheet, it's always to be the actual return because it's the actual return that increases the value in the pension fund. We'll look at that more closely later in the video. For now, let's determine the actual return on plan assets. So the pension fund increased by $128,500 over the year. But that's not all attributed to a return on assets because the company made a contribution and the plan paid out benefits. The paid benefits must be added back in and the contributions must be subtracted out to determine the actual return on the plan assets. We determined the amount to be $138,500. If we were to compute the expected return on plan assets, we would multiply the beginning pension fund balance by the expected rate of return. In this year, those amounts are the same. Now we're going to enter the $138,500 in the worksheet. Again, the worksheet properly includes the actual return, not the expected return, so the line item is accurately labeled actual return. The return on plan assets decreases pension expense and increases the pension fund. The next item is benefits paid out of the plan to employees. Remember that benefits are paid from the plan, not the company. Benefits paid have no effect on financial statement accounts. It reduces the PBO, reflected here with a positive number recorded in the PBO column, and reduces the value of the pension fund, reflected with a negative number in the pension fund column. The next item is prior service cost amortization. The textbook walks you through the use of sum of the year's digits method to determine the amount. The first year's amortization amount is determined to be $13,636. This amortization is an increase in pension expense, reflected here with a positive number in the pension expense column. It's a decrease in the total amount to be amortized, reflected with a negative number in the AOCI column to the right. Recording these amounts in this way will enable us to more easily determine the summary journal entries to make at the end. The next line item is pension contributions. The company contributed $115,000 to the fund. This increases the pension fund balance, reflected here with a positive number in the pension fund column. It decreases cash, reflected here as a negative number in the cash column. This is the only item that will affect the cash column. Now let's prepare the totals. Total all columns except the pension-related liability and AOCI columns in the middle. Next, we'll determine the balances in pension-related liability and accumulated other comprehensive income that we didn't total. As you may have noticed, you can't just add up the amounts in the pension-related liability column. The amount to be entered, just as you learned earlier in the chapter, is the difference between the PBO and the pension fund. Remember to be mindful of entering these as positive or negative numbers. A negative number indicates a credit balance, which is what you would expect of a liability. It's shown here as a negative $101,500, the difference between the PBO and the pension fund. Next, transfer the AOCI total from the right AOCI column to the AOCI column on the left. The worksheet is complete, and we can prepare the summary journal entry for the year. The journal entry consists of a debit to pension expense, a credit to pension-related liability, and a credit to accumulated other comprehensive income. The amounts to use come from the worksheet. Pension expense is the total of all items affecting pension expense, reflected in the first column. Pension expense includes service cost, interest cost, and prior service cost amortization, all which increase the expense, and actual return on plan assets, which decreases the expense. The total is $115,136, so we enter that as our debit to pension expense. Now the amount to record as pension-related liability isn't as straightforward as it may seem. It's coincidence that it exactly matches the balance on the worksheet. The amount to record as pension liability is actually an amount to adjust the beginning balance to the ending balance, taking into consideration any contributions made. If we started with a credit balance of $115,000 and then reduced that balance with a debit of $115,000, which is the contribution amount, how much do we need to arrive at a new credit balance of $101,500? That would be a credit of $101,500. If you need to take a moment to think about this, pause the video and do that. It will become very important in the next year's journal entries. Finally, we have the amortization of the prior service cost, which, if you recall, is initially reported in accumulated other comprehensive income. We reduce the total amount reported in accumulated other comprehensive income over time through amortization, reflected here as a credit of $13,636. Next, we record the contribution from the company to the pension fund. To record this, we debit pension-related liability and cash to reduce each of those accounts by the amount of cash paid. So think about this for a minute. You just increased pension-related liability by $101,500 and decreased it by $115,000, so we report the difference in that account on the balance sheet, which would be a pension asset of $13,500, right? No. If you think about this carefully, the $115,000 cash contribution decreased the beginning balance in pension-related liability to zero. Then we increased it again with a credit of $101,500, the difference between the PBO and the pension fund. The amount to report on the balance sheet is the $101,500 credit, which is a pension-related liability. Let's review what is reported on the financial statements. The pension expense of $115,136 calculated on the worksheet and recorded in the journal entry is reported on the income statement. The cash outflow of $115,000, in addition to reducing the balance in cash reported on the balance sheet, is reported as a cash outflow from operating activities on the statement of cash flows. The $101,500 pension-related liability is reported on the balance sheet. The balance of the prior service cost yet to be amortized, which is $61,634, is reported in accumulated other comprehensive income, which is included on the balance sheet. Now let's move on to the next year in the example, in which more complexities emerge. We're given the following information. Service cost is $87,000. The company made a contribution to the plan of $75,000. The plan paid out $132,000 in benefits. The actual return on the pension fund assets is $26,350. Actuaries determined the PBO needs to be increased by $80,000. The obligation discount rate is 11% and the rate of return is 10%. Here's our worksheet. We start with beginning balances, which were ending balances from the previous year's worksheet. Items such as service cost, interest cost, actual return, benefits paid, prior service cost amortization, and pension contribution are calculated and entered into the worksheet in the same way as the previous year. But now we have two new items, deferred loss and PBO change. We'll look at those one at a time. So far we've been lucky in that the expected return on plan assets and the actual return have been exactly the same. But that's not normal. The difference between the two is deferred. So how do we do that? We were given that the actual return on the fund was $26,350. That's what we entered for the actual return line item on the worksheet. But let's look at the expected return. The expected return is the pension fund balance at the beginning of the year times the expected rate of return, which gives us $151,350. That's a difference of $125,000. Since the actual return is lower than the expected return, this is considered a loss. It's generally assumed that variations in the return on assets will go up and down over time, but in the long run will be fairly close to the expected return, so this loss is not recognized in net income. Instead, it's reported in accumulated other comprehensive income. The reasoning is similar to that of reporting gains and losses for available for sale securities. To account for the deferral, on the worksheet, we reduce pension expense by the amount of the loss, shown here with a negative amount. We record this loss in an additional column to the right under AOCI. It's recorded with a positive number because that reflects a debit or a loss. Remember earlier in the chapter, you were told to always use the expected return on plan assets when calculating pension expense, but then on the worksheet we record actual return. Here's why. When there's a difference between the two, resulting in a deferral, the net effect on pension expense still results in the expected return on assets. It's separated on the worksheet because we need to track the amount in accumulated other comprehensive income. But remember, when asked to compute pension expense, always use the expected return, not the actual return, because the net effect of the actual return and the deferral will result in the expected return. Next, we have an increase in the projected benefit obligation determined by actuaries. This might happen due to interest rates, life expectancy of the employee, or salary rates that change over time. It's not for an accountant to determine the amount. It's provided by an actuary. The accountant takes the amount and enters it into the worksheet, and it's also recorded as a deferred gain or loss. We'll look at the worksheet entries next. The change in this example is to increase the projected benefit obligation by $80,000. This is entered into the worksheet as an increase to PBO and a decrease to AOCI, represented with the appropriate positive and negative amounts. This change is not directly journalized, but it will affect the amounts reported on the financial statements because we've increased the PBO and decreased the AOCI. To prepare the worksheet for journal entries, again, we must total all the columns except pension-related liability and accumulated other comprehensive income. Determine the balance to be reported on the balance sheet for pension-related liability by finding the difference between the PBO and the pension fund, just as we did before. Add up both items in the AOCI section on the right and enter the total into the AOCI column on the left. This will give us the total amount to be reported in accumulated other comprehensive income. Let's look at the first summary journal entry. The first summary journal entry includes a debit to pension expense for the amount in the worksheet, just as it does for any other year, regardless of the other complexities. The amount comes straight from the worksheet total. Next, we debit other comprehensive income for the amount of deferred loss. This will ultimately be closed to accumulated other comprehensive income, so the accumulated comprehensive income on the balance sheet will show the total amount indicated in the middle column of the worksheet. Next, we credit pension-related liability. Remember I said earlier, it's not simply a matter of using the total on the worksheet. Instead, we have to determine the amount that will be needed to arrive at the balance to be reported. The balance to be reported is $344,800. If we started out with a credit balance of $101,500 and decrease that amount by the contribution of $75,000, how much do we need to bring the balance back up to the total credit balance of $344,800? That computation is shown here at the bottom, and it's $318,300. Finally, we credit accumulated other comprehensive income for the amount of the prior service cost amortization, just as we did in the previous year. The textbook shows this journal entry as two journal entries to differentiate between the pension expense and the PBO revision. This is perfectly fine, and if you add up the debits and credits, you'll find the amounts match. I've simply combined them here to demonstrate how to determine each amount. Now we have the journal entry to record the contribution, which is a debit to the pension-related liability and a credit to cash for $75,000. Your textbook might present a journal entry that has an amount of $115,000 if you don't have a version that's been corrected. $115,000 is a typo. The contribution amount is $75,000, not $115,000. Here we have the final part of the example, the third year of the pension plan. Service cost is $115,000 and the company made contributions of $80,000. Benefits were paid out in the amount of $140,000. The actual return on the pension fund is $175,500, a considerable increase from the previous year. The obligation and expected return rates are the same. Our worksheet begins with the ending balances from the previous year entered as beginning balances here. Each line item is calculated and entered into the worksheet in the same way as the previous years. This year, we have yet another complexity to consider, and that's whether or not the deferred gain or loss needs to be amortized. A corridor amount is an amount used to determine if amortization of a deferred gain or loss is required. If it is, the corridor amount also determines how much of the deferred gain or loss is to be amortized. To determine the corridor amount, calculate 10% of the PBO and the pension fund balances at the beginning of the year. Then determine which of your calculations is larger. Compare the amount you determined is larger to the total gain or loss that's been deferred. If the gain or loss that's been deferred is larger than your amount, you have to amortize. Presented here are the computations. After calculating 10% of the PBO and the pension fund, I can determine that the larger of the two is $182,765. I then compare that to the deferred loss balance of $205,000. Since the deferred loss amount is greater, I have to amortize. The amount to amortize is the difference between my amount and the total deferred loss, which is $22,235. It's not shown here, but the textbook describes that the expected remaining service life of the employees is 5 years. This total amount to be amortized is then split evenly between the 5 years, giving us $4,447 per year. This amortization is another addition to pension expense and reduces the balance in the deferred loss column on the right. Presented here are the summary journal entries. I'm not going to go into these in detail because the amounts are derived from the worksheet in the same way as last year. So, as if all that wasn't enough, I do have some practice exercises for you to try. Again, I strongly recommend working these because they will set the foundation for the calculations and concepts you need to apply in the homework. So pause the video, work the problems, and continue when you're ready for the solutions. Presented here is the solution to practice 1711. I've presented the solutions to 17.9 and 17.10 at the bottom because this information is needed to prepare the journal entries. The first journal entry consists of a debit to pension expense for the amount calculated in practice exercise 17.10. Next is a debit to other comprehensive income for the amount of loss that's deferred. To determine the amount of the deferred loss, we compare the actual return, which is given in the problem, with the expected return, which is calculated by multiplying the obligation rate by the PBO. Finally, we have a credit to pension liability. The amount of pension liability to report on the balance sheet is the difference between the PBO and the pension fund, which is $12,000 minus $10,400. Those balances were calculated in practice exercise 17.9. The beginning balance of the pension-related liability was an $800 credit. We also had a contribution of $1,050. Using the method I described in the video, we can determine the amount to be credited to pension-related liability in this journal entry is $1,850. The second journal entry is simply the one needed to record the contribution. Presented here is the solution to practice exercise 17.14. Pension expense is service cost plus interest cost plus expected return on plan assets. Since the expected rate of return is different for each scenario, the pension expense is different. The exercise asks you to compute the balance of net pension gain or loss. This is important because it affects accumulated other comprehensive income. In each case, the expected return is netted against the actual return to arrive at a gain or loss, and the gain or loss is then accounted for with the beginning balance of the gain or loss. Pause the video if you need to review the solution in detail. Here we have the pension worksheet for practice 1716. This is a good exercise because it covers many of the complex elements I just went over in the video. I won't go through this example in detail, but you can pause the video if you'd like to review it. This concludes the video for Chapter 17. Please be sure to read the sections that I didn't cover in the textbook.